Hi again, it's Douglas Lucky Larson with Real Estate Deals and Retire Early and Often. And today we're looking at inflation. Yes, inflation, that dreaded word. Now, let's talk about this just a little bit and what inflation really is. If you listen to some really smart guys like, let's say, Jim Rickards, Peter Schiff, Brent Johnson, George Gammon, Danielle DiMartino Booth, and many others, they have a great explanation for this battle that's going on between technology on one side, automation, AI, and also cheap globalized workforce that we can always tap into for, cheap stuff. That's on one side, bringing prices down. But on the other side, dollars being pumped into the economy in all kinds of ways by the federal government and the Fed, Federal Reserve. They push money into the marketplace, but that is chasing fewer goods and services available, making the prices go higher. So you got deflationary forces on one side of the scale and inflationary forces on the other. And so we have this debate all the time, whether the future will hold more consumer price inflation or disinflation. Or that, which is, disinflation is not deflation. Disinflation is just less inflation. And then there's deflation itself. Will prices actually come down? Well, it's important to know that consumer prices are very different than asset prices, including, like, say, stocks and real estate. We've seen a huge appreciation in those, especially over the last, say, 10 years. Wow, stock market crazy, real estate crazy. So we've had that kind of inflation off the charts. But now it's hitting Main Street with consumer prices. Well, the government, especially in the USA, has a very low estimate for many things in their CPI, consumer price inflation. They admit that we've got some inflation, but they have a distorted view of what that really is. So they have a very low estimate for things like, say, rent. Their version is called owner equivalent rent, which is where they ask property owners what they think their home would go for if it was rented. That's not real market rent, as you probably know, on Main Street. Either economists are dumb or they're purposefully hiding the truth. Yeah, more like it. But it's, they have a vested interest in keeping things lower so that they don't have to pay out more. They also don't count things like fuel and insurance, but I'm pretty sure that makes up a part of most people's budget, an important part. Anyway, it's clear to see that we have inflated prices on almost everything right now, including the cost of labor and fuel, which in turn make everything else go up even more. Now, again, our government statistics are actually admitting that we're seeing some significant inflation, although they keep calling it transitory and temporary. But they don't give any idea about the time frame on when that's going to end. Maybe prices should come down. No, they're not talking about that. And those prices are what we call sticky in many ways, especially in rent. You think that's coming down anytime soon? Common sense says no. Now, these inaccurate measuring sticks say that we've got between 4 and 5% consumer price inflation. And they have an incentive, once again, to keep these things low. They don't want to pay for cost of living adjustments, COLA, when they make payouts for Social Security and for military and other federal pay, as well as pensions for these folks. So they only want to admit a fraction of the real inflation because you can see it really hurts their bottom line, which means that they have to come back to you and me and take more taxes. I'd say ask for more taxes, but they really don't ask. They just take. So I saw this article the other day in Money Magazine just this week, and it highlights another negative outcome, a negative knock-on effect from inflation. And most people just don't think about it until early spring each year. Let's read. So if we zoom in on this article right here, we'll start right at the top. Again, Javier Simon, I think, is the author. This is in Money Magazine. If you're making more money this year, congrats! But how much is it really worth? Thanks to unusually high inflation, the prices of everything from groceries to pet food have increased. So, while there may be more money in your pocket, it's possible that you can buy less. Yeah, duh. If that's not enough to give you goosebumps this Halloween season, here comes bracket creep. And he's got that in quotes, and he explains it. This phenomenon occurs when rising income pushes you into a higher tax bracket. But inflation decreases your purchasing power. Ooh, yeah, that's something a lot of people don't really think about. Basically, Uncle Sam sees you are making more and taxes you accordingly, even though your higher earnings are not actually worth more. Yikes. It's a real case of love this. More money, more problems. Yeah. So, let's talk about this just for a minute. And I always like to give people, some helpful hints, right? Not advice, but helpful hints. And it drives me crazy with articles like this that there's no mention of things that can be really helpful to most people on Main Street. But let's look at their suggestions for how can you protect yourself from inflation. First one, negotiate a higher salary. Yeah, nobody's ever thought of that before. Genius. Go ask your boss for more money. Of course, that again puts you into a higher tax bracket than you're in. So is it a solution or more money, more problems? All right, next solution. Also, stick to your long-term investing strategy. And I love this. In the past century, the stock market average annual return before inflation has been about 10%. So stock prices right now are at an all-time high, and yes, the federal government would like to see asset prices continue to remain inflated, but I don't know, can you count on that? Is that your investment strategy? Just invest in more stocks? I don't know. Well, for me, it depends on what kind of stocks we're talking about. Let's see. Down here, here's another just brilliant plan. You can also invest more in a 401k. That's good. That's good. Actually, it is pretty good. So especially if you've got some kind of a matching program, that is free money. You put in 3% and they match another 3 in your retirement account with your company. Hey, it's free money. You're doubling your money. I think that can be a good strategy. Now, when you're 20 years old, it feels like forever before you can actually realize any gains from that. But when you're a middle-aged person and you're putting money in and maybe you're only 10 years away from retirement, that can really add up. It talks a little bit more about contributions and retirement plans, IRAs. I love Roth IRAs. If you have a chance, you've taken some money out of a 401k and you want to roll it over into a Roth because you changed jobs or you left the workforce or something, you can roll it into an IRA. And if you do a Roth, you pay some taxes, but once you start investing that, then it grows tax-free. Woohoo! And you can take it out tax-free. That's the bonus of the Roth. All right, talks about some contribution limits and different things. Check with your tax advisor. Here's the thing that really drives me crazy, though, is when they're giving you some helpful hints on what you can do, there is no mention of maybe becoming a little entrepreneurial and picking up a side hustle or something. There's got to be something you can do to bring in some extra money. I mean, how about some extra consulting work? Are you in the gig economy or something? Maybe you can do a little more tapping away on the keyboard and bring in some extra greenbacks. Maybe you've got some handyman skills. A huge demand for that right now. I know a lot of landlords like myself. And I just paid $65 an hour for somebody to take care of some small needs I had in Southern California because I'm not there right now. And I needed some things done. And $65 an hour was sure cheaper than me flying down there. So handyman gigs at $65 an hour, maybe that's the right thing for you. How about drive for Uber or something like that? I've seen some of the numbers there, and they're not too bad. I've actually got a tenant who drives for both Uber and Lyft, and he brings in $4,000 a month. and that's in the off season. When we've got ski season going on, he makes another 50% more than that during the ski season, going between Salt Lake City Airport and Park City, where all the ski resorts are. Wow. I also know a guy that has a day job, and he also has a couple tiny house Airbnbs, and he brings in about $60,000 per year in net rent. Now, that's on top of his day job. So there's things that you can do, right? Right now, I'd sure appreciate if you could go down below and hit the like button, thumbs up. That would really help. Subscribe if you haven't already. Please share these videos with others. Um, let's look at maybe some other things that we can do besides just the standard lame solutions that Money Magazine comes up with. Again, I'll offer infotainment, not advice, okay? Because I'm not a professional and you need one. I like to buy dividend-paying stocks from solid, proven companies, especially in industries that look like they will do well. In the last downturn, companies like Walmart and Costco and like Dollar Tree did very well because people always need the basics. I've heard that investment in companies like Rio Tinto should do very well and pay a dividend on an ongoing basis because of their mining operations continuing to ramp up around the world for materials that are currently needed and will be needed even more in electronics and alloys and green energy, as well as they're also continually mining for gold and silver, which may likely go up in value as well. Now, I've also held some stock in ExxonMobil for many years, and even when I'm whining at the gas pump, I can at least feel pretty good that my stock is going up. Of course, my favorite assets are single-family homes in Main Street, ordinary neighborhoods where equity and rents both increase with inflation. Even in the last downturn, where prices of the homes went down, rentals were a great store of wealth because, again, even as the prices came down and people got kicked out of their homes because they weren't making their payments, they had to go somewhere. People like to live indoors for the most part, and rents actually went up. So, a 30-year fixed mortgage rate now at 3%, a little above or a little below. Wow, what an incredible way to keep ahead of 5% or 8% or 15% inflation. The math is pretty simple, even for me. Now, I know people who have also trickled lots of money, a little bit at a time, into cryptocurrency over the last 5 years and have done very well against inflation. I think that's likely to continue, even though there may be some bumps and drops along the way. If you are a crypto fanboy or fangirl, you don't need me to explain crypto to you, but if you'd like to know more, I really like Mark Moss in some of his videos, who does an excellent job explaining the potential of crypto and blockchain, how it's doing now, and what it's expected to be able to do in the future. Now, I hope all this helps, and I hope to see you on another video soon. Thanks.